Welcome, great minds. My name is Emmanuel and I am your host today. In this video, I'm going to be introducing you to the concept and the strategy we will be running with on this channel to achieve our goals in the financial market. So, without further ado, let's get right into the video. So, the first thing is the concept. We will be utilizing the inner cycle trader concept, popularly known as ICT. The founder and the mastermind of the ICT concept is Michael Hodderson. I hope I got that correctly. Okay, so a big shout out to him. Now, inside the ICT concept, there are so many strategies that one can learn, master, and use on your trading journey. However, I decided to go with the London Kill Zone strategy. I have been using it for a while now, and it's really effective with up to 80% win rate when applied correctly. So, now let's dive into the main matter of today, which is how to use the London Kill Zone strategy effectively. So now we need to come over to the chart and start looking at how to really use this strategy. Okay? So I think it's important before we even start looking at the chart, let me show you guys the highlights of how to use this strategy. So the first thing you need to understand is that this London Kill Zone strategy works with time. Okay, it's not something you can just come to the market anytime and expect to trade. No, it has a specific time of the day in which you are going to come to the market and start analyzing in order for you to find a trading position. Okay, so that is it. And that is one of the things that makes me to like this strategy the most, because this avails you the opportunity to plan your day effectively. So you know when to do what and when to do the other. Unlike every other strategy that is, you can just come up anytime. So this is the best bet for me. Okay, and I think for every other person too, especially if you are a student or if you work, right? So you can really plan your day well and be able to meet up with things. So let's quickly consider the time. Okay, so the beginning of the London Kill Zone is from 7 a.m. to 10 a.m. London time, or from 2 a.m. to 5 a.m. New York time. So in case wherever you are in the world, it's preferably you calculate your time with the New York time. You can easily convert that to your own time, right? As a trader, it's best you go with this. So, but for us in Nigeria, the London time is the same thing with our time. So if it's 7 a.m. to 10 a.m. London time, then it's still the same thing with us, exactly the same with us in Nigeria here. So if you're elsewhere, you can go out to Google and convert this New York time to your own time zone, and you'll be able to find the right time for you to take the trade. Okay, so let's continue. Now we have clarified when to come to the market. I'm going to be showing you guys some indicators you can use to help you map out all these time zone in your chart, though that is not really necessary, but yeah, you might want to just use it for clarity purposes. So the first thing is understand the daily bias. So what's your daily bias? Your daily bias is simply understanding what the market is going to do for that day, simply understanding the direction of the trend for the day, right? So that's the first thing we want to do, right? And I said earlier that in order for you to start trading with the London Kill Zone, you have to go to your 4-hour time frame, right? And then from the 4-hour time frame, you can consider what your daily bias is. Okay, and with the look of things, you can easily tell that this is a downtrend, meaning the market is heading downward. We can easily tell that this line is not like this. Okay, if the line is this way, you know the market is going up, but if it is this way, then you know that the price is going down, and that is what it is, right? So anyway, we will not be using trend lines. For those of you who are familiar with trading, we will not be using trend lines much. I will show you what we'll be using. I'm just trying to use the trend line to outline the trend of the market, because we can see the market creating a lower low, lower low, lower low, and the lower high. So we just move to the 1-hour time frame and also look at what the market is doing on the lower time frame. So on the 1-hour time frame, we're going to start forecasting from this point now, from this particular point here. Okay, because this one is more recent than going too far. So even with the recent one, we can still see that this is a downtrend. This is a downtrend right here, right? So with this being said, we may want to now move into the lower time frame, either 15 minutes or 5 minutes, in order to start finding the right things that we need to look for in the market. But before we do that, let's really like analyze this the proper way to be sure that the market is really going down. And let me place something here for you, because we'll start analyzing from yesterday. Yesterday is Friday, so let's assume that this is when we came to the market. So it means everything by the rights, we've not seen it, we don't know about it, we only know about the things here. Now if you look at this market from here up, you might be tempted to say that the market is going up, right? So let's clarify if this market is truly a downtrend or not, because that is very important. You don't just have to assume, you have to be sure technically, because of course this is a technical analysis, right? So first of all, let me remove all these things from the chart so that the chart will be clear for now, at least, because we don't need them for now. Okay, none, and then none. This is the indicator I was telling you guys about, but for now we don't need it. So let's have a clean chart like this. So that means we came to the market, and the only thing we can see is from here upward. These things by the right, we don't know about it, we've not seen it, because it's still yet to happen, and we don't know if it's going to happen like this or it's going to go the other way around. So let's analyze if we're truly in a downtrend. So from here, markets keep giving us lower low. Market went high, did not break this high, and gave us another lower low, and went high, created another lower high, and then went down again and did not break this one, but gave us another higher lower high here. So this is an indication that the market is going high, but something significant happened right here. Something happened right here. So something happened here. So when the price got to this point, look at that. The price was supposed to maybe come up. The price was not supposed to break this. It's not supposed to break this high here. It's supposed to maybe, after creating this high, this lower high, and then it will move down below this lower low here. That means we are still in the downtrend, but something different happened, and that might be an indication that the price is about to change direction, meaning there's about to be a reversal. But let's see if this is true. Okay, because the price came and then went up this way, instead of tried to come down but couldn't achieve that, and went back up again. And at this point, I think this high here was broken. You can see that the high there was broken right here. So, and if you look at the movement, the price begin to create a lower high, right? Meaning that this high is, meaning that this low, sorry, is higher than this low. So it's a lower high. And but then market came down here, tried to respect this zone here as well, and went up to break this one with a wick, but did not close above it. Okay, so this is still valid. But then market came down and broke this level here. But let's see if the other level, if our ultimate level was broken. Price actually closed below the body of this other ones, but did not close below the wick. So this is not valid yet. So but then what happened is the price went up and broke this high right here, broke it completely, like closed above it with this bullish candle here. So now we can call this a change of character. In ICT concept, we call it MSS, which is market structure shift. That is what just happened right here. Okay, let me bring this one and move it there. That's what happened right there. And the guy that did it is this candle here, this bullish candle. So now there's a change of character. There's a shift in market structure. It means the price might start going up. The price might reverse and start going this way instead of the former way that it was going previously. But I don't think that's the case. So how we can know this, even assuming we have not even seen all these things that happened from here to this red point, the way we should know that this is not true is the way we know that this market is not really reversing is this. We can use our Fibonacci tool. We draw it from, because this is the highest high, this is the highest the point we have in price, right? So, and then this is the lowest point here when the market got and began to misbehave, right? So we'll draw our Fibonacci tool from there down to this point, and anything above here is the premium, and anything here is discount, right? And if you want to buy something, every one of us like to buy things in a discount price, right? But when you want to sell your stuff, you would like to sell it at a premium price, meaning at a higher price, right? Even more than what you bought it, right? That's how we all behave, right? So now anything above this 50% equilibrium is the premium, and anything below the 50% equilibrium level is the discount level. So, and the institution would regularly like to buy at the premium price, right? And when they want to sell, they like to sell at the discount, and that's what is going on here. Remember, for you to succeed in using the ICT concept, you need to understand that basic message the ICT preaches is that you have to trade with the institution. You have to run alongside with the institution. You have to understand what they are doing and move with them, because if you don't, you will be on the opposite side. So imagine you trading against somebody that is trading with billions of dollars and trillions of dollars. So the institutions are the banks, okay, they're the big boys. They call them the whales in the market. So you don't want to trade against them with your little $100 or $5,000 or $1,000. Okay, you want to make sure you run alongside with them. That's how your position will not be liquidated. So with that out of the way, we now know that what we're going to be watching for is, so the first question we want to ask ourselves is, why did they have to come up to this premium level before they start going down? Why? Now, if you look at this, there's something called efficient price delivery, or the price delivery, I think efficient price delivery actually. So these terms are usually a challenge for me. So let me show you something. So you can see this fair value gap. So there's a fair value gap here, and that simply means that this candle like this is not the right price delivery. This is not the right price delivery model, right? So the way price delivery works is this way. Assuming that this is a candle, right? That way and that way. You see the way it's going. So it's going down, but it has to go like this. So it means that all others are being filled, right? But when you see price begin to move in a way like this, goes down like this, and then another one goes like this. Oops, I got the wrong tools, guys. I wasn't even watching. And another one goes like this, then another one comes like that. Then there is a problem here. Okay, there are others that probably have not been filled in this position, and it's called liquidity void. So what is going on here is that there is a fair value gap right there. Okay, you can see there's a gap here. So that gap is what we call the fair value gap. And most times, the algorithm, the price delivery algorithm or whatever that the institutions are using will likely come back to fill in the orders in this point, to fill in this gap, to fill in the fair value gap before the price continue to expand to the right direction. So that is what we see happening right here, and that's what the institutions came right here to do. Okay, and after filling that point, you can see how price begin to react. Immediately price got to those levels. For example, all these levels like this, all those candles, you see those long candles, the way the movement of those candles. So all those levels like that. So just watch how price begin to react when price got to this level. There is this rejection that begin to take place, and most importantly, once the price got to the fair value gap, the price the rejection became very, very obvious. So, and that tells you, if for example, if I'm here watching this market, I think we even took this trade. I can't recall the date again, but I'm just going to show you the trade we took here on Friday. But I think we took this trade. Yeah. So that is it. So with this, we can now be sure that the price was just trying to test that zone and then begin to come back. So obviously we are still in a downtrend, right? So with that being established, let's move forward. Since we've gotten daily bias, so the next thing we want to look at is number 2, which is a sweep of the Asian high and low. So in order for us to do this, we need to go down to the lower time frame. Okay, we need to go down to the 15-minute time frame or the 5-minute time frame. So I would like to use the 5-minute time frame myself. So now it's time for us to go and get our indicator. I'm using the indicator just for you guys to easily understand these things. So this is of course the high of Asia and this is the low of Asia. So we want to wait and see how price sweep this Asian high. So we can see that happened right here. So let us zoom in more so we can see these things better. So that's exactly what happened here. When price came here and swept and closed above Asia, it must close not just the wick, but it has to close above it. Okay, and that is exactly what happened on this point. So then let us let's go back to our chart and see. So we've seen this happen, right? And then the next thing is to go to step 3, which is to find a market structure shift. Okay, but before we do that, I want to explain something to us about this sweep of Asian high or low. You can see there is high or low. So you might be asking, how do we know where to watch out for? Why did we watch out for the sweep of the high and not the sweep of the low right here? Why that? Now the thing is this, the way you're going to know what to watch out for is based on your first assignment. So if the bias of the day is a downtrend, then you have to watch out for, if the bias of the day is a downtrend, then you have to watch out for a sweep of the high. But if your bias for the day is an uptrend, then you need to watch out for the sweep of the low. I hope you get it. For example, this price is supposed to come down, right? But before this happened, the price went up first and deceived many people. And many people thought the price was going to go up. And then the price later started advancing down. But this movement that happened here was a sweep of liquidity. This was the institutions grabbing liquidity of people. Okay, liquidity simply means money. Grabbing those liquidity, which is the stop loss of people's orders. So grab those and then expand to the right direction for the day. So that is the concept here. So in order for you to know what to look out for, that is why you must follow these things step by step. Do number 1 first. If you do not do number 1 and jump to number 2, you will have problems. So do your number 1, get your bias. Your bias will now lead you to know if you have to watch out for a sweep of the low or a sweep of the high. So our bias said the market is going to go down. So now we watch for the sweep of the high. And that's exactly what we just did. So we watch out for the sweep of the high right here. So the number 3 thing to do now is to wait for a market structure shift. Okay. So let's watch out for a market structure shift. Let's really consider if this is a valid market structure shift. So yeah, we can say this is. So we don't have to measure this from this. So how do we know that there is a market structure shift? We know that by watching the market do the opposite of what it was doing before. So this is what the market has been doing. The price has been going up, right? So it came down. This is the lowest point. The market came here but did not close. Okay, this is the lowest point now. The lowest point is this. So if there's going to be any market structure shift, it should be, actually this looks like a market structure shift. Look at that, guys. It looked like it is, but it is not. It looked like the market structure shift even happened between here and here, but that's not true because this is still our Asian high and this is where the sweep of Asian happened. So we should start looking for market structure shift from here. I hope you are getting it. Let me use this thing to differentiate. So we start looking for market structure shift from here onward. So let's go back and consider what's happening. So this is our recent low. So this is where we're going to be searching from. So this seems to be our first market structure shift. We can consider this actually, but it is not very clear, so we'll leave it and watch what the price is doing. So price went up, came back and touched the same level. Remember, when you're trading this strategy, you need a lot of patience, guys. If you're not patient, you have problem, because you need to really cool down and watch what the institutions are doing. So, and here is where the market structure shift happened. So we move and start looking for number 4, which is to find an institutional reference point. So we find it, above the level that caused the market structure shift. I should have highlighted it, but take note, you find your number 4 above the level that broke it. So you don't have to, like, after seeing the market structure shift, then you start looking for the institutional reference points below, like after it. No, you go back to that movement that broke it, that gave you that market structure shift, is the area you start looking for that. And we can see something here. Okay, here is a fair value gap, right? And here is an order block. So now the concept of market structure shift is that, the concept of the London kill zone is that once price breaks the Asian high and create another high, so it's regarded that the price is not supposed to break that high again. Okay, that's the highest point. It has taken away liquidity of the Asian session, and the next thing is going to expound down to the direction it's supposed to go, and without breaking the highs, the new high that has been created. That's the major concept with the London kill zone. Okay, so but do you see that this trade was wrong? Because this should be our highest point right here, right? But unfortunately, after this happened, the price was supposed to just come back to this fair value gap, like for example when it got to this on this black candle here and then moved down. But the market came back again and even broke our high here and created a high here. So what is the problem? I'll show you what the problem is. We traded this market yesterday and we made some profit from it, but I'm going to show you something very important. That's why you need to watch out for these things when you are trading in the morning. Very important. So this is from here. Let me show you from here. If you check our time, if you look below our time, you're going to see this is 6 a.m. My time, but that's actually 7 a.m. So you wait for 1 hour. You need to wait for 1 hour. So 1 hour is right here. You need to wait until 7 before you start looking at what the institutions are doing. The reason you need to wait till 7 is that most times the what do they call it? Is it Frankfurt or something? They are still the Asian section is still open. It's still open even until this point. That's the point. It's still open even until this 7 a.m. Until this 7 a.m. to 8. So you have to wait until 8. Okay. Remember, this is 7 a.m. Don't regard my time. My time is a little bit backward with I don't know the kind of time that this the MT4 is using. So yeah, it's backward 1 hour. So but this is actually the 7 a.m. London time, of which is 7 a.m. my own time in Nigeria, but it's showing 6 a.m. right there. So you wait for 1 hour again, which is to 8 a.m. before you start taking action. And this is exactly why the silver bullet strategy is taken from 8 a.m. Remember, that is the strategy I was trading previously before I started trading this one. So you wait till 8 a.m. before you start taking significant actions. Though, that will depend on the movement. That's why you have to watch diligently the movement, okay? So, with that being said, it means that this high right here is not the actual high that we should work with in this contest. So, we work with this high in this contest. So, we are going to wait and watch price sweep that high. Okay, wait for price to sweep this high before we start taking relevant action. So that is very important. Why do we know that? Now watch the way the market is, the price is moving. After I sweep it, it came down, went back up again, created a lot of wicks, came down again, and then went up again, created a lot of wicks here. So for you to take a trade here is not a good idea. So you have to understand that because this zone, you have to understand that this zone is still valid because the Asian session is still open right here. So anything happening within this 1 hour time frame, you should just keep your finger crossed and be watching the movement and be watching the price action. Okay, so now we take action from this level, from this candle. So what for the sweep of this high? So with that, you see this high was sweeping here, so it means our number 2 is actually achieved right here. So we wait for number 3. Number 3 is shift in market structure. So down now we can wait for that to happen. So the market structure shift took place right here because our new lowest point is this. So we put something right here and wait for the price to break it, to break this purple. Oops. Okay, this one should stop here, right? That should stop there. Then we wait for something. This one should start here. That's our lowest point. So we wait for a break of that point. So now that finally happened right here. So remember the fourth thing to look out for, which is an institutional reference point, fair value gap, or an OB, is from the level that broke it. So you don't have to go to this highest point and start looking for it. You come to this level. This is the level that finally gave us the market structure shift. Now that is where the thing happened here. So now let's find an institutional reference point in order for us to start trading. So let's bring back our boss to this place. So this box is going to be here. So there's a fair value gap right here. Look at it. The low of this candle and the high of this candle created a fair value gap, and that's the level we are taking our trade from. So you wait. When price came down here, rejected, and came back up into this level, this is where you want to pick your trade. And where do you want to set your stop loss? You set your stop loss at the very high. I like to set my stop loss at the high, but you can set your stop loss. You just find you can find the other block that created that bearish movement and put your stop loss there, or at the top of the candle that created the fair value gap. So people do this in different ways. So you could actually, let's say you open the order right here, so you could put your stop loss at the top of the candle, the fair value gap, candle that created the fair value gap, which is this one, or you go to the other block. Any one you did is okay, right? So let's assume we did this, which is of course what I did. Of course, I usually like to use the other block, so which is here. That gives us about 7 pips, right? 7 pips right there. So let's see what we are targeting now. How do you know where to target your take profit, where to put your take profit? So you don't just assume the market is going to give you anything. No, you have to target areas of liquidity. Okay, for example, this is an area of liquidity. There are of course liquidity above this low, recent low, and then this low, and then if you zoom out, you're going to find more of that. If you zoom out, you're going to find it. So those are the levels. See that level right there? There is liquidity resting above that level, and those are the kind of level you want to target in your take profit. You target that level. That's a very important level too, and I think this level as well. So this one is just the one that was created in the London session. Obviously the price is going to break it. That one is certainly sure. So you can put your first target around this level here, this level which is on the Asian session. Okay, and finally the Asian low. This is actually the Asian low. So we target the Asian low. There's liquidity resting below that, and then this low here. So with this we are good to go. So this is how you can set your TP. So let's zoom back in and see how that would have been. So here, remember our stop loss is 10 pips, right? So we assuming to be taking our order from here, the top of that green. So and then our first TP is 22. That's already giving us 1:3, because it only takes 21 pips for you to get 1:3 with a 7 pips stop loss. So you have already made 1:3 just on this first retracement, on the first retracement that happened. Okay, second after this one, this small one here. So this on the first retracement you got your 1:1, and on the second retracement you're already making your 1:3 ratio, which is awesome. That's already where you should be closing. If for me, that's where you should be coming out. But you want to close partials, and if you want to hold the market longer, of course, to take to your second stop loss level, second take profit level, then you want to take partials from this level and then hold it to this level, and then you close your final trade. But however, the price kept going down to 42 pips before it finally expanded up again and then came down back. So, but right here, you are out of this market right here. 1 to 3, that's enough, and you are done for that day, right? So that's how the London kill zone strategy works. So before we go, I'm going to show you guys another example. Now, I want you to remember something. Don't forget that these things have already happened before we are looking at them, but trust me, this is not how it's going to be. So every single day I'm going to be making a video, if I can, to show you a live trading. Like at a point in time when I'm trading, I'm going to be going live on YouTube for you to join in, and then we can analyze the market together and take our positions together. So you get to see me do this thing live, not just after it has happened, live. And this position was traded yesterday by us. So let me show you another one. Let's look for another stuff. So this is the day before yesterday, which is on Thursday. Okay, let's see if we can find something here to trade that day. And okay, let me take this off. So the first thing we want to do, let's go back to this place, is to find our daily bias, right? So let's find daily bias for the day. So we're going to keep this thing. Okay, this thing is okay where it is. So we assume we've not seen anything that happened right here. So we only know of this thing down here. So let's find, what do we think the price is going for that day? So let's go back to the 4-hour time frame and see what is really going on. So let's zoom in a little bit. Wow, we've lost my stuff, but let's go to 1 hour. Hopefully we're going to find, yeah, this is it right here. So so this is what, it should be here. It should be here. I don't know why that went far. This is due to the timing, the zoom out stuff. So it's right here. So so now let's try to understand the bias for the day and see. So from our previous calculation, this price is still in a downtrend, right? Still in a downtrend, but this has not been broken yet. So but we'll be hoping that will happen for the day, because the price came down here and then went up a little bit. So, and if we measure this, we can see that the price was just trying to fill in those liquidity void right here. That's what the market was trying to do, and you can obviously see the fair value gap. If you understand these things, you see how price respects these things, because this is the institution, this is how it works. It's an algorithm. So that's how the price delivery algorithm works. It respects it every single time. So you see how it came back into this level, price came back into this level to fill in the fair value gap right here. I mean, everything happened right here, right here. That's the fair value gap down to that point. So respect it, fill in those points, and then expanded down. So that is what is going on right there. So there is no this up movement cannot indicate cannot dictate to us that the price is actually going up. And as you can see how the wicks that is being created. So the bullish momentum is not strong at all. So it's still a downtrend. However, so we'll be expecting a downtrend that particular day, right? So with that being established, let us move down to the 5-minute time frame and look for what we need to do. So let's go to 5-minute time frame and find it. So let's also go like this, come back. So this is the point here. So this is what we've seen. So now let's the high, remember the price has to sweep the high of Asia. So this is the high of Asia here. So price need to sweep the high of Asia here. So let's wait for that to happen. But interestingly, the price just came down, keep coming down without taking off the high of Asia, and unfortunately we will not be able to find an entry in this kind of market. So price rather took out the low of Asia right there. Price took out the low of Asia right there, and that was what happened. And after taking down the low of Asia, went up a little bit, came down, and just keep going down. So in a day like this, you will not be able to trade. So you leave it. You don't have to trade every single day. You can't force it to happen. You leave it and wait for the next day. Okay, that's the good thing about this strategy, to help you not to be in the market every single day. Okay, so you move to the next day. Let's see what happened the day before. So again, we all know that this market is a downtrend, right? We've all let us go back. Let's not assume. Whoops. So we're talking about this level here. So let's place it. So we're already expecting a down movement, as we have already established from all these calculations. This was where the market came to fill in this fair value gap. So we're expecting the market to go down, and that's what happened here. Price expanded down after those rejection, expand down, and right here. So we know that the market is coming down. In fact, we should be expecting price to come and break the low of this day. That's what we should be expecting. Though it happened, it didn't happen that day actually, but it happened the next day. So there's a lot of liquidity here, and that's where price is coming for. So we should know that after we have seen this movement here. But another point you want to target also, remember, price most liquidity point to another liquidity point is this particular level, the low of this level here. So, and of course that particular day price broke through that level. So we know we are expecting a downtrend if we do our analysis here, after doing our analysis on the 1 hour time frame. So let's go to the 5-minute time frame and confirm what is going on. So this is it here. So this is the high of Asia. This is the high of Asia right there. So we wait for a sweep of the Asian high. Now this is very interesting. Okay, we can learn something new from here, unlike the first example. So you can see now, look at the behavior. Immediately the London session started, price broke through a proper sweep of the Asian high. You see that? Took off this level, because this level is higher than this level in terms of body of the candle, right? Took it off and took off this one as well, right? This week took it off. So with this kind of movement, you already know that this is the right price action we are looking for from the open of London, in order for us to start taking actions from the beginning of London section. Else we'll have to wait until after 1 hour. But most importantly, you keep watching the price actions. That is very, very important to know what they are doing, and you start taking relevant actions from after 7 till 8, which is 7 in my time here. That's when you start taking relevant action. Take good note of that. Okay, so after the sweep of this Asian high, what happened? Let's go to this place to know what to do. So price sweep it. Sorry, daily bias, we got that. Sweep of the high, we got that. Now let's wait for a market structure shift. So that one happened. Okay, right here, this is our recent low. This is our recent low here. Okay, it's our recent low. So, and this is a proper, like I said, you keep watching the price action. Okay, this is a proper market structure shift. A proper one is this. So you see how that happened, and the price went down, and you can see the order block right there. So and of course the valid order block is the one that has a fair value gap attached to it, and that's exactly what we see here. So the perimeters are met correctly without any manipulation, correctly met. Okay, so with this kind of setup, the next thing we need to do after seeing this market structure shift, the next thing we need to do is to find an institutional reference point, and that is this order block and this fair value gap. So why is this fair value gap, why is this order block a valid one, and this fair value gap is two things to take note of. First, the fair value gap that has an order block. The order block that has a fair value gap, that is number one. Number two, that also caused a change that caused a break of structure or a market structure shift. And that's what happened here. So you see that? So it means this order block is valid. So if you are trading order block, you want to trade from the order block. Okay, from the order block. So you take your trade when the price got into the order block. But for this our London Q zone, you have to focus on taking your trade from the fair value gap. Okay, but if there's another block with the fair value gap, then that gives you like a double confirmation on your on your entry. Okay, but however, take your trade from the fair value gap. So, and that's what we're going to do. So we took a trade right here. And where are we going to place our stop loss? We'll place our stop loss at the top of the fair value or the order block. Remember what I told you the last time? That's how I do mine. Except for any other thing, that's when you want to consider moving it higher. So we keep our fair value, our stop loss. Oops. So we keep our stop loss. Keep our stop loss. We take our trade right here, just at the beginning of that fair value gap. So keep our stop loss right there. That's about 10 to 11 pips. 10 to 11 pips. Okay, I think 10 pips actually. 10 pips. So keep it a little bit above it. That will give you around 11 pips. So where are we going to take our profit? Our first TP, let's zoom out. Let's zoom out. So we can see a point here. There's liquidity here. There's no doubt. There's liquidity at this point. You see, it's even the same level here that this place was touched. But before we had this market structure shift, price moved down to another significant level. Let's look at it. You see, it's almost the same point here. So it means there's liquidity here. So place our first. We placed our first take profit there. Now, if you're wondering why I placed it here and not here, because this, let's zoom in. The reason is that this our first down movement. This low that was created with our break of structure is actually went below it. It broke through that one. So that has been taken. It's no more valid. So you go for something below it. Okay, I hope that is clear. So let's zoom out again to check our major points of take profit. So major point is this level here. There are liquidity residing around that level. Say, okay, that's the level we want to take from. Or we can just take from this level before that level. Well, our target is here, but we'll take it earlier before, which is this low here. So that's how it's going to be. So let's see what percentage we get. So we take a trade from there, and then first one is 14. That's 1-to-1. That means you want to leave it. You don't want to take it from 1-to-1, except you want to take partials or something, but you don't want to take from there. It's not up to 1-to-2, so you leave it. So we target our major take profit is actually up to 40 pips. So it's up to 40 pips. 40 pips right there. 42 pips right there. So when you divide that by 11 or 10 pips, you see you are making 1-to-4. So you can actually get out of the trade around this level here. I think you should have 1-to-30, 130 something around that level here, 135 here. You can actually get out around this level after the second retracement. So that is it, guys, about this strategy. You can go ahead now and test it, but according to ICT himself, this strategy only works on GBP pairs and Euro pairs. Okay, it doesn't work with other things apart from that. So you can see I'm using it on the GBP USD pair. So you can go on and on and on and test this and see how the strategy works. This is very effective strategy, and give your comment and review about it. So that is all on this video, and I hope you understand the whole thing. So the most important thing you want to put in mind is understand this concept, the time zone, and then the things you need to watch out for before you can take the trade. And most importantly, be patient. Always be patient in the markets. Be patient. So remember the 1 hour thing I told you. It's true that The London Key Zone started from 7, but most times you want to wait until 8. Just watch that 1 hour, see what price action is within that 1 hour. That will give you a clue of what to do. So we always have that patience in you, and I'm sure you will be good. So thank you for watching. Have a good time.